The screen glows in the darkness of the room. A trade that looked perfect only minutes ago is now unraveling candle by candle. Red floods the chart. Your P&L flashes like an emergency warning. A notification hits your phone, then another, then another. Your heartbeat speeds up. Your hand hovers over the mouse. Close the trade? Hold? Add more? You already know this feeling. The strange thing is that this moment has almost nothing to do with charts. It has everything to do with being human. Because the most expensive losses in market history were never caused by bad indicators, imperfect entries, or missing information. They were caused by something far older than the stock market, older than computers, older than money itself. They were caused by the human brain. And hidden inside 53 years of trading psychology is a realization that changes everything once you see it. The market is not a machine designed to reveal opportunities. The market is a machine designed to reveal people. Every fear, every weakness, every illusion, every emotional blind spot. The market finds them all. And it does so with terrifying efficiency. Imagine standing on a trading floor in the early 1970s, phones ringing endlessly, traders shouting prices across crowded rooms, papers scattered everywhere, millions changing hands in seconds. Technology has changed since then. Human psychology has not. The same fear that caused panic selling in 1973 is still causing panic selling today. The same greed that fueled bubbles decades ago fuels crypto rallies now. The same emotional mistakes continue repeating generation after generation. Different charts, same humans. And that raises an uncomfortable question. Why do intelligent people keep making the same trading mistakes? Why can someone spend years studying technical analysis and still sabotage themselves at the exact moment execution matters most? The answer begins with something most traders never notice. Your brain was never designed for markets. It was designed for survival. Thousands of years ago, survival meant avoiding danger quickly. Reacting instantly kept people alive. Hesitation could be fatal. But here's where things become dangerous. The market punishes the very instincts evolution rewarded. When prices collapse, your survival brain screams, "Get out!" When prices explode upward, it screams, "Don't miss this." When losses accumulate, it whispers, "Win it back." And that's exactly why so many traders lose, because they are bringing Stone Age wiring into a modern battlefield. You have probably experienced this yourself. A trade moves against you. Your chest tightens. Your stomach knots. The loss feels personal, not financial, personal. The strange part is that neuroscience reveals something fascinating. The brain often processes financial pain in remarkably similar ways to physical pain. Think about that. A red number on a screen can trigger reactions powerful enough to override logic. And this reveals a powerful psychological principle. Most losing trades are not actually lost when the stop loss gets hit. They're lost when emotional thinking replaces objective thinking. The market was teaching a lesson hidden inside that loss. The real battle isn't between you and the chart. It's between two versions of yourself, the emotional self and the observing self. The traders who survive decades learn how to strengthen the observer, not eliminate emotions, observe them. Because emotions aren't the enemy. Uncontrolled reactions are. But that's not even the real trap. Something else was happening beneath the surface. A trap responsible for destroying more accounts than almost anything else. FOMO. Picture a chart exploding vertically, green candles stacking like rockets, social media filled with screenshots. Everyone appears to be making money except you. The notifications keep arriving. Your heartbeat accelerates. You tell yourself you're waiting for confirmation, but the market keeps climbing. Then comes the thought, what if this never comes back? And in that single question, psychology takes control. Because FOMO has very little to do with money. It is fundamentally social. For thousands of years, being left behind by the tribe created danger. Belonging increased survival. Isolation increased risk. Today, markets exploit the same circuitry. You aren't just afraid of missing profits, you're afraid of being left behind. And here's the lesson most traders miss. The market will always create another opportunity. Your emotional brain believes this opportunity is unique. Professional traders know it isn't. This is exactly why experienced traders do the opposite. Instead of asking, "How much can I make?" they ask, "What happens if I'm wrong?" One question activates greed, the other activates risk management. And that tiny shift changes careers. But the market had another lesson waiting, one even more destructive: revenge trading. The silence after a loss is different. You know it. No notifications, no excitement, just frustration. A trade failed, then another. Now your confidence begins evaporating. You stare at the screen. The market suddenly feels personal. And that's when the danger appears. You stop trading the chart. You start trading your emotions. The next position isn't entered because it meets criteria. It's entered because you want relief. You want justice. You want the market to give back what it took. The market, unfortunately, doesn't negotiate. And here's where things become fascinating. Behavioral economists observed something unusual about human decision-making. People often become more reckless after losses, not less. Think about that. The worse things get, the more aggressively people try to recover. It's like a gambler doubling down after every defeat. The emotional brain becomes obsessed with restoration. The observing brain disappears. And this reveals another principle hidden inside 53 years of trading psychology. Every trade has two outcomes: the financial outcome and the psychological outcome. Most traders focus only on the first. Professionals obsess over the second. Because a controlled loss strengthens discipline, an uncontrolled reaction weakens it. One costs money, the other costs identity. And identity changes everything. Losing traders often see themselves as people trying to win. Consistent traders see themselves as risk managers. One identity chases outcomes, the other follows process. One needs to be right, the other needs to be consistent. And here's what most traders never realize. The market doesn't reward being right. It rewards managing uncertainty. The greatest traders in history were wrong frequently, yet they thrived. How? Because they understood something hidden inside every chart. No trade matters. The series matters. One candle means almost nothing. 1 month means little. 100 trades reveal the truth. And suddenly, the emotional pressure disappears because you stop demanding perfection from every position. You start thinking probabilistically, the same way casinos think, the same way institutions think, the same way market makers think. Individual outcomes become less important. Long-term execution becomes everything. And now imagine that opening scene again: the glowing screen, the flashing red numbers, the accelerating heartbeat, the position moving against you. Except this time, something is different. The chart hasn't changed. The market hasn't changed. The risk hasn't changed. You have. And in the strange world of trading, that changes everything.